Good morning, ladies and gentlemen. I'm pleased to introduce Maurice Chéniaud, Chairman and CEO of Altamir Gérance, and Eric Savia, CFO of Altamir. They will comment you Altamir's 2020 results. Maurice?
Thank you, Claire. Good morning, everyone. So let's start, if you wish, by the private equity market in 2020. As you can see on page 10, and contrary to what I was thinking, the European private equity market registered a record level of activity in 2020, both in terms of investments, as you see on page 10, with 181 billion worth of investments, and similarly in terms of exit value on page 11, with 169 billion of divestments. So these numbers have been achieved despite the COVID-19. And in terms of exit, I always say that there are three levels of exit. Two are IPOs and dividend recaps. We don't have the numbers for those. We could expect that they should be lower than in 2019, but in terms of M&A exit, again, a record year. In this context, if you move to page 13, the key highlights for Altamir in 2020 was a 13.7 NAV growth compared to 30.8% in a year ago. This was driven by a 13.1% average EBITDA growth of our portfolio companies, slightly lower than the 17.2% of 2019. We registered 159 million worth of divestment, obviously lower than the record year of 378 million last year. We made 8 new investments compared to 12 last year, for 113 million worth of investments compared to 198 a year ago. And finally, we ended the year with a net cash position of 42.2 million compared to 71.1 million. I will comment now those numbers. If you move to page 14, you see that we had 159 million worth of divestments and proceeds in 2020, 113 from full exits, 6 full exits, and 46 million from partial exits. And if you move on page 15, you can see that the 6 full exits, and apart from Amplitude, which was sold at 1.4 times our cost, all the other investments were divested at a multiple which was higher than 2.7 times invested capital, with a 5.4 times multiple on the Idealista divestiture. On the right-hand side, you see the partial exits, and I would like to stress that these partial exits are either, like in the case of ECI Software Solutions, a situation whereby basically we sold the company, but we decided to reinvest part of the proceeds to continue the adventure. And some of the other exits, such as ThoughtWorks, Paycor, were basically pre-IPO rounds with a view to take the company public. And similarly, Genius Sport is an exit mechanism through a SPAC. And as far as Duck Creek Technology, which is listed, basically where shares were sold on the stock market. Moving to the investments on page 16, you see that we registered 113 million worth of investments, almost the same level in terms of new investment as last year, with 8 new investments compared to 6 new investments a year ago, and a good vintage if you look at the history over the last 5 years. If you move to page 17, we provide you with a description of the new investments which were made in 2020. Innovate as you can see, was made alongside Apax 10 LP. It helps senior lives live independently in their homes, and you will see in a few minutes post-event that the company went public last week at a very high valuation. Mental Better is a Dutch company where we invested almost 30 million alongside Apax France 10. It's a provider of mental care in the Netherlands with 120 locations, and the investment thesis is obviously to increase that penetration and to increase geographically the development. Odigo is an investment which was made alongside France 10, and we invested 34.3 million, which includes a 10 million co-investment alongside the fund. Odigo is an omni-channel cloud platform that supports company in the management of their customer interaction. MyCase is an investment alongside Apax 10 LP, again a provider of software and payment services to the legal profession, which is one of the less developed in terms of software and IT. Ascensio Software is another TMT investment. It's a carve-out of a large group, and where we were able to buy the software business at a very attractive valuation. In the consumer field, you recall that we invested in Cadence Education in early 2020. Unfortunately, just when we invested, the 225 private preschools were closed. But since then, they are reopening, and we expect this poor period to be over. Moving to the next page, we made two investments in the services business. One in a listed company called Car Global, which is a B2B platform that connects buyers and sellers of wholesale vehicles through their automotive auctions. And basically that we bought a convertible bond in this listed company with a downside protection. And finally, we invested 17.8 million alongside Apax France 10 in Crystal. Crystal is a platform investment in the field of independent financial advisors, which is a highly fragmented market, and we expect to buy and build the approach. And as you can see, we had very few follow-ons to protect our companies, which show how strong our companies were in terms of management. On page 19, all these translate in a 13.7% NAV growth, which includes the 66 cents dividend paid in May. And so we ended up the year with a 30.90 € per share compared to 27.75 per share. I now hand up to Eric, who will explain to you how that value creation was achieved.
Thank you, Maurice. Hello, everybody, and thank you for your attendance. I'm going to begin on page 20. I'm going to begin with the analysis of the 2020 NAV bridge. As you can see, we have created 210.7 million euros of value on the portfolio over the period, which represents a return of almost 21%. Out of those 211 million euro, the realized gain is 33.3 million euro and is mainly linked to the exits Maurice has mentioned earlier. But most of the value creation comes from the unrealized gain for 177 million euro, which includes a negative impact of foreign exchange for almost 24 million euro. It's the first time ever we have such an impact of foreign exchange, and this is mainly linked to the many companies we have now in other currencies than euro, mainly the US dollar, thanks to the exposure we have in the Apax LLP fund in the US, and also to Marlink, which even if it's a European company, the company is operating in dollar. I will come back to this unrealized gain in a second. In the meantime, the NAV has been reduced by 28.5 million euro, covering all our direct and indirect operating expenses, including VAT. VAT and taxes. Another deduction of 40.6 million euro is a provision for the carried interest. This is linked to the increase in the unrealized gain I just mentioned before. The next item is the financial results, so minus 2.5 million euro, which has strongly recovered since the end of June. After the 24.1 million of dividend deduction that were paid in May 2020, 66 cents per share, we reached the NAV of 1,128 million euro at the end of December. On the next slide, page 21, we can see the split of the value creation by sector. 86% of the value creation is due to the tech sector, 7% to the healthcare, 5% to consumer, and 2% to the service sector. Among the tech companies, we can mention the stronger place on Experio, who created 44 million euro of value thanks to the alignment on the offer received by Apax at the end of the year. And we can just also mention that on all those companies, 8 companies, Experio, Thoughtworks, Jack Creek, Genius, Paycor, ECI, Innovate, Sandoya, and Tom Group have faced liquidity events either at the end of 2020 or at the very beginning of 2021. On page 22, the graph on the left is the detail of the value creation in terms of unrealized gain. The main explanation of the value creation is the multiple expansion that occur over the period for almost two-thirds of the value creation, and also the EBITDA growth, which has a positive effect and reflects the increase of 13.1% of EBITDA on the portfolio Maurice mentioned in the highlights of the year. The change in net debt is linked to the increase of debt that many companies of the portfolio have used during the year. No company did face any cash issue during the COVID crisis, but they have used all the available tools, and sometimes they had used an increase in debt. That's why. The chart on the right represents the portfolio bridge over the year. I will just highlight that even with the exit made this year, the total value of the portfolio keeps on increasing thanks to the good level of investment and the value creation we have made over the year. We have almost a gross portfolio return of 20% over the year. Let's move on to page 23. The portfolio at cost is increasing compared to the pro forma value of 692 million euros at the end of last year. This pro forma value includes the deals that were signed but not closed. Altamir has managed to increase its value to 766 million euros at the end of 2020. It now stands at 104% of the statutory net worth, which is a very good level of invested capital. Moving on to page 24, in terms of portfolio valuation, we can see that 92% of the portfolio is valuated using comparable multiples. 5% is valued at cost. Those 5% are mainly the little deal made by the Apax fund, and 3% are valued using a listed price at the end of December. On page 25, we have the evolution of the uplift. The uplift being the difference between the exit price and the last value we had in our book prior to the exit. And this uplift of 25% for 2020 demonstrates the cautious valuation we have on the portfolio company in our books. Page 26, the outstanding commitments at the end of December stand at almost 600 million euros, and we have split them in 2 parts. One for the 2016 vintages. We have less than 50 million euros linked to those vintages, and more than 550 million euros for the last vintage in which we have invested, being the 2019 vintage for Apax France LP and Apax 10 LP. Those almost 600 million euros will be invested over the next 4 years, almost 150 million euros each year. And I will just mention that for the 2021 investments, out of those 155 million euros, 136 have already been invested by the Apax France 10 and Apax 10 LP funds, but not called yet, as the fund use credit line at their level. Moving on to the cash situation on page 27. The statutory net cash position at the end of December stand at 42.2 million euro in the statutory accounts and minus 5 million euro in the IFRS accounts. We have 90 million euro of credit facilities available at the end to date versus 30 million euro at the same period last year. The statutory cash could be split into 49 million euro of IDR funds, and we have a net borrowing of minus 7 million euro. I now hand over to Maurice, who will discuss the post events.
Thank you, Eric. So moving to the post events in the first quarter of 2021, very active, as you can see. The first item is that Altamir sold its direct and indirect investment in Tom Group for 104 million worth of proceeds, and has reinvested 100 million with the management team and new shareholders, thereby becoming the reference shareholder with a 40% stake into the company. Apax France 9 has sold Expero with a view to reinvest 30% of its proceeds approximately alongside the new shareholder after two years of investment, so with a significant uplift. The other divestment, again in Fund 9, was Sandaya, the outdoor accommodation leader, to a fund managed by Infravia, again with a significant uplift. Similarly, Apax LLP has announced 3 acquisitions via the Apax 10 LP fund, PIB Group, a leading independent specialist insurance intermediary, Urjavec Group, an award-winning global managed security services provider and cyber operation leader, and finally, a reinvestment in Idealista, the company that we sold for 5.4 times cost to EQT, and EQT bought at the same time as it bought Idealista, the Italian leader in the same real estate platform, and we were offered the opportunity to co-invest in the new company. And finally, as I mentioned earlier, Innovate went public last week and the share price was up 100% compared to our last valuation at the end of December 2020. And finally, Apax Digital announced a significant divestment, and Apax Development announced the acquisition of a new company. Moving to the portfolio, as you know, I've always said the value of your company is the value of its portfolio. And you can see on page 30 that we had at the end of December 55 companies in the portfolio, representing 1,267 million euros of fair market value. 24.6% were direct investment, and 75.4% via the Apax funds, and you can see the spread between those the different funds. On page 31, you see the diversification of the portfolio. I would like to stress the fact that the tech sector, TMT, represents 57% of the portfolio at the end of December 2020, driven by the new investment, but also by the sharp increase in valuation of that portfolio compared to the other sectors, as you have seen earlier in the presentation. By vintage, you can see that the portfolio is well diversified, meaning that in terms of exits, that is very important for the exit. And finally, by geography, you can see the diversification of the portfolio. As you know, we like to say that we backed growth companies, and the way to prove that is to compare the growth of our portfolio companies, the EBITDA growth of our portfolio companies compared to the 36 largest industrial companies in the CAC 40. And you can see that while our companies delivered a 13.1% EBITDA growth, the largest CAC 40 companies delivered a minus 13% EBITDA growth. On page 33 and 34, we break down both the portfolio at cost by sales growth and EBITDA growth, and you can see that the COVID had quite an impact on sales growth, because you see that 21 portfolio companies representing 62% of our fair market value at negative sales performance in 2020, while only 38%, 18 companies had positive growth, and 9 of them had even 20% plus sales growth. However, when you move to page 34 and you see how well our portfolio managed the sales decline, you see that only 16 companies representing 42% of the portfolio had a negative EBITDA. So therefore, and on the contrary, 23 companies representing 58% had positive EBITDA growth. So it shows how well managed our companies were. On page 35, we provide you with valuation multiple. On the EV/EBITDA multiple is roughly flat at 12 times 79, 12.8 multiple compared to 12.65 a year ago. And similarly, the leverage is flat compared to a year ago at 469 compared to 482. So nothing particular to stress. On page 36, we provide you with 16 largest investments, which represent 80% of the portfolio at fair market value. And as you can see, all these companies are valued above cost, but even the other companies, as you can see, globally are valued at cost and above cost. So we are very pleased with the performance of the portfolio. Now moving to a quick snapshot on the 16 largest investments. As you can see on page 37, Marlik, which is the largest investment, which represents 14% of the portfolio, had a great year despite the COVID, with flat revenue but 4% EBITDA growth, despite the fact that the company had 1,000 vessels backlog, which could not be handled due to the COVID crisis. The enterprise business unit delivered a very strong performance. And finally, at the end of the year, the company bought one of its US competitors. Experio, which, as you know, was divested in the first quarter of 2020, and where we would reinvest 30% of our proceeds, had a great year with 43% revenue growth and 24% EBITDA growth. And that was driven by the direct sales growth, by the fact that high value added products were again in large growth. And finally, the company was able to buy the number 2 companies in the sector. And so that explains why we had an unexpected approach 2 years after our investment to sell our company. BIP, which is an Italian-based European leader, management, IT, and digital transformation consulting firm. Again, despite the fact that the consultants had to stay at home, the company delivered a very strong revenue and EBITDA growth, driven by organic growth and a significant acquisition in the UK, which enlarged the European foothold of the company. Thoughtworks, a leader in digital transformation and software development, had a fantastic year, despite the fact that the second quarter was tough, delivered a 7% growth in revenue and a 48% EBITDA growth, driven by a major margin improvement. When we bought the company, the margin was at 10% of sales, and now EBITDA margin is at 20% of sales. And again, the company is in the process of going public with pre-IPO rounds, which explain the change in valuation. Infovista, a leading global provider of network performance software solutions and services. You may remember that the company suffered a few years ago. We changed the CEO, and the results are there with the first half of fiscal year 2020 show 15% EBITDA growth, driven mostly by the global network division, which represents 90% of EBITDA, and driven by the 5G network deployment and significant OPEX control. And finally, the company just made a significant transforming acquisition in Q1, which will close hopefully in a few weeks' time, and which will change dramatically the company, and we will expect to make a follow-on investment, equity investment in that company. Destiny, which was a 2019 investment of Fund 9 France, is a provider of secure cloud communication solutions to innovative companies. Again, significant performance both in terms of revenue and EBITDA, driven by organic growth and build-ups. 2 build-ups were achieved in 2020, and others are in the pipe. And that company obviously is a beneficiary of the COVID due to the fact that people had to communicate through communication services. Odigo, which is an investment which closed in December, it's a leader in contact as a center principally for large companies, and again the company delivered a 2020 results in line with our investment thesis. Greatech, which was a 2019 investment again, it is a provider, distributor of building information modeling software. The company suffered from the COVID, and therefore with slightly increased revenue and flat EBITDA. And the reason for that is the fact that while the Autodesk VAR business was maintained, the company suffered from the mix of their own proprietary software. However, a major transformation program is in place, and several build-ups are in the pipe, so that we expect the company to deliver a 2021 strong performance. Baker, a U.S. provider of HR and payroll services, obviously since the company model is a revenue based on fee per employee, the company suffered during the first months of the year. However, the company recovered, and again, the company is in the process of going public with pre-round investments. And finally, Vocalcom is a software and multi-channel technology provider for customer contact services. The company has had a flat year due to the fact that while the SaaS business, which represents 50% of sales, continues to grow, the license business and the hardware have been hit by the crisis. Moving to the services portfolio, Antoria is the negative, which is the second largest French wholesaler broker specialized in supplemental insurance protection and self-employed people, is the disappointing news of the year, with revenues and EBITDA down by 20%, which explains why the valuation of the company has been marked down by 33 million, and 33 million, which are backed at cost. The company was valued at 1.10 times and is marked down to 1 time cost. Again, a new management team has been put in place with the support of a well-known Eastern consulting firm, and so we expect, as we did in the case of Europe Snacks and in the case of Infovista, to turn around the company. AEB, a world leader in biotech ingredients and related services for wine, food, and beverage. Obviously, the company was impacted by the market, the down market in terms of wine and beer due to the closure of bar and restaurants. However, the company was able to grow its EBITDA due to the new acquisition which was made in Denmark, and the fact that the equipment division is progressively returning to profitability. A major digital transformation is again in action. Moving to the consumer, Tom, which is a leading jewelry retailer in Europe, despite the fact that the stores were closed full year in November and partially in Germany and Italy in December, the company was able to deliver in the last quarter, maintain its EBITDA despite the 9% decrease in sales, and so which is very important because the first quarter of the year represents 50% of the EBITDA of the fiscal year. And Snacks Development, which is a leading European producer of private label savory snacks, was a beneficiary of the COVID, and again, strong performance in terms of revenue and EBITDA, despite the fact of increasing raw materials. Alain Flelou, which is leading European franchisor of optical and hearing aid products with 1,400 stores. Again, the fiscal year which ended in July was hit by the COVID with revenue down 17%, EBITDA down by 34%. However, the new fiscal year, the company is ahead with sales increasing by 15% and EBITDA by 25%, compared to a period where the stores were not closed last year. And finally, Sandaya, which is a leading operator of premium campsites in France and Spain, again hit by the COVID due to the fact that at the beginning of the season the camps were closed, but the company was able to, at the end of the season, July, August, to recover, and the company was able to maintain basically its EBITDA, and so we sold it. It has been sold in Q1. Now moving to the value creation drivers are obviously the same one as the previous year: operational excellence, consolidation and acquisition, internationalization, financial flexibility. But I would like to stress that digital transformation is becoming the key word in our portfolio today. Moving to the NAV and share price performance on page 47, I am pleased to show you that Altamir is outperforming its benchmark index, which is the LPX Europe NAV, which comprises the 30 largest European listed private equity firms. And as you can see on page 47, over 10, 5, 3, and 1 year, we are really beating the competition, if I could use those terms, significantly. And this is achieved with a low intrinsic risk profile. We have a prudent financial strategy, no leverage at Altamir level, no overcommitment, no currency risk on fund investment. We have a conservative valuation policy, which show that the uplift, which is demonstrated by the uplift. And finally, we have a diversified and healthy portfolio in terms of sector, geography, and maturity, and reasonable leverage in the portfolio. In terms of dividend, we will propose at the AGM €1.09 per share dividend, which is really 3% of the 2020 NAV, which represents 92 cents per share. But we will add the 17% share dividend that we didn't pay for the year of 2019, so to bring the 2019 dividend to 3% of NAV. Moving to the Total shareholder return, Altamir again is outperforming both the LPX Europe index and the CAC Mid and Small by a significant margin, as you can see on page 50. And in terms of historical performance since inception, basically you see that the more recent portfolio is delivering significant growth, because already it's valued at 1.83 times cost compared to 208 for the divested portfolio. In terms of objective, you may recall that we had set for ourselves objectives as we do each year, but then with the advent of the COVID, we revised the objective, and then we decided to drop entirely our objective since we didn't know how the year would develop. However, we think we are very pleased to show you that in terms of investment, divestment, and value creation, our achievements are very close to our initial objectives and higher than our revised objectives, both in terms of investment, divestments, and value creation. And for the coming years, we have decided to give you a long-term view instead of a short-term view and so we expect for the next 5 years to invest 170 million per year on average, compared to 140 million per year on average over the last 5 years, to divest 230 million per year on average, compared to 200 million on average the previous 5 years, and basically to deliver the same type of value creation, but we have set up an objective of 7% minimum average EBITDA growth, organic growth. I want to stress the fact that 2021, due to the 100 million divestment of TOM and 100 million investment in TOM, we will beat significantly. We should take out this 100 million in the objective, so the 170 million is without the 100 million of TOM investments. Finally, in conclusion, why should you invest with Altamir? It's a unique value proposition which allows you to get access to the APAC's investment throughout the world. It's a growth-driven strategy with double-digit annual growth and ambitious strategy focused on long-term growth. Shareholder return is our main objective, with a yield of 4 to 5% per year and double-digit total shareholder return, and low intrinsic risk profile, well-diversified portfolio by sector, geography, and maturity, reasonable leverage, conservative valuation policy, and rigorous cash management, and no structural debt at Altamir level. An experienced and committed manager, which owns 65% of the share capital and has more than 45 years of experience in the sector, and finally, a tax-efficient structure. So thank you very much for your attention, and thank you for your support, and we are at your disposal to answer any question you may have. Claire, our investor relations, and Eric, our finance director. Thank you very much, everyone, and have a good day.
Bye-bye.
Bye-bye.
C'était plus long que d'habitude, hein?